This chart shows the California Buyer Purchasing Power Index, BPPI, calculated by RPI. This figure tells us how much mortgage principal a home buyer can borrow today compared to a year earlier based on changes in mortgage rates. The BPPI figure declined to negative 26.6 in June 2022. This figure tells us a home buyer with the same income and down payment today is able to borrow 26.6% less mortgage money than a year ago. Yes, 26.6% less. Since a home buyer qualifies for a mortgage amount based on their income, any rise in mortgage rates instantly cuts the amount they can borrow or pay for a home. The BPPI will remain negative in the coming years, but the decline won't be as dramatic as during 2022. We are now facing years of a cyclical upward rise in mortgage rates and restrained mortgage borrowing, which began in 2013, briefly interrupted by the pandemic in 2020 and 2021. Expect all property prices to take a hit as interest rates resume their upward march. And of course, on top of rising interest rates, buyer purchasing power has been assaulted on multiple sides, with rapid inflation further depleting home buyer wallets. This chart displays stock pricing on the S&P 500 index, the red line, paired with the price-to-earnings ratio, called the PE ratio, which is stated as the capitalization rate, how real estate investors price property. The PE ratio is depicted by the blue columns. Gray columns indicate periods of economic recession. Stock prices descended in the second quarter of 2022, plummeting from record highs. The PE ratio has fallen back to 18.9, equal to a cap rate of 5.3%. Not great, but an improvement over 2020 when the cap rate equivalent was a meager 2.5% return. The stock market has declined over 20% from the January 2022 peak. After years of being completely detached from reality, stock market speculators are finally reining it in as they take huge losses in value. For cash-heavy real estate investors, wait and look ahead to the next buyer's market when property prices will have fully declined. This will arrive around 2025. This chart shows the path of home sales volume in 2019, the black line, alongside sales volume so far in 2022, the orange line. As you see, the pandemic economy completely distorted the 2020 and 2021 annual sales figures, represented by the dashed lines. As of May 2022, year-to-date sales volume is 10% below 2021 and falling. However, for a more accurate picture of sales volume trends, let's compare 2022 sales volume to 2019 sales volume. Why? Well, since 2019 is the last relevant year that was unaffected by the pandemic. While sales volume in 2022 started off at a faster pace than in 2019, volume prematurely peaked in March, quickly tapering off to below 2019 pre-recession levels. The deep cut to available mortgage funds caused by 2022's rapidly rising interest rates foretells slowing homebuyer acquisitions. Thus, after 2 pandemic years of volatile, atypical surges in sales volume, expect sales volume in 2022 to end the year slightly below 2019, then continue downward in 2023 through 2024. Now, what's the big takeaway in all this? Well, view 2022 as a transition year. We are heading from the disruptive years of the pandemic economy to the continuation of the recession, which first, briefly, hit in 2020. Expect this recession to officially begin later in 2022. A word of advice: real estate professionals who wish to weather the coming storm will prepare their financial survival strategies today.
In a world of generic CE, it's finally time to start enjoying your real estate education. Introducing First Tuesday's video renewal course, Real Estate Made Real. California's first and only DRE-approved video-based renewal experience. Get an exclusive preview and enroll today. Be the star of your career.